So everyone, I'm Kushbu Jha. I'm the CEO of Buy Properly. And we are a platform for fractional investing in real estate. So allowing people to invest for as little as 2,500. And actually for the first time investors, it's only 500. Um, it's an honor to welcome Ron to our webinar today. Ron is the president and CEO of Meadowbank Asset Management. He's a portfolio manager and has over 17 years of experience in the financial services industry. He was a partner at Caprian Group, and of course, he's a wealth management consultant. He has an MBA and an MA in economics from York University. These are his credentials, but having worked with Ron for the last 3 years, he's probably the smartest person on Bay Street that I have ever met. So it's an honor to have him here and hear his views on something very important today, which is, as a portfolio manager, what does he think of the current market scenarios? We think it's volatile, but maybe he doesn't. And really curious to know what his views are, what he sees large family offices, institutions doing that retail investors could learn from. So welcome, Ron. Thank you for joining us.
Thank you, Kushbu. You've been so kind. You actually made me younger. My experience is now in over 22 years. I guess my one of my profiles hasn't been updated, but thank you so much.
Apologies.
And you're absolutely right. It's been rather volatile so far year to date, and the volatility definitely will continue. So please direct any questions you wish. At our firm, obviously, we manage money. And obviously our money that we manage are primarily for long-term. And the key is, to set the tone up for this is when looking at volatility, like you rightly said, it's a function of somebody's risk tolerance and someone's overall time horizon. And that's when volatility really becomes an issue. Longer term investors, this is a blip, but obviously shorter term investors that are looking to play the market, yes, it can create undue strain, given that nobody can time the market properly. It's never been done successfully. So please fire away with any questions you may wish. I can go on a diatribe forever, so I don't want to. I want this to be as focused as possible.
So why don't we start there, Ron? Like, what do you think is the definition? Is there like a technical legal definition of volatility? How do you define a volatile market? Because from a retail investor perspective, every time there's like something major going on, it feels like it's volatile, but I'm wondering if there's like an official definition to say, okay, if it changes by this much, it is considered volatile or not.
Well, essentially, when you look at volatility is really a measure of how much and how often a security's price or market moves up or down. Now, mathematically, and you probably see it, a lot of investors could see it when they look at online, volatility really translates to standard deviation. Now, somebody turns around and says, well, what's standard deviation? Standard deviation is really the mean of how much that stock will move away from the mean. But like I rightly said, it's a function of what time frame are you looking at. So if you turned around and looked at a particular stock and said, let's make a bank and compare a bank, and you use a base year of, let's say, 5 years ago, and you compare it to now what they're doing, you can say it's volatile because 5 years ago would be your base, and you're seeing that deviating from the mean. And when it's deviating from the mean, the thing is how much is it going up or how much is it going down within what time frame? And that's really the measurement of volatility, right? So when someone says, well, how do you mathematically prove volatility? It would really be the standard deviation away from that average of what that stock or that market or that index would usually deliver. So that's the definition of volatility.
Got it. And so in that definition, does today's time fall under a volatile market, or is it just plain recession that we are in now and it's downturn and it isn't so much volatile, it's just going down, down and down?
The answer is yes, it does fall under a volatile market. but not everything is, all stocks are created the same. Certain areas, certain stocks, certain sectors are not as volatile as traditional, other areas, let's say, that can be a little bit more volatile. And you see volatility, it's more or less in this current marketplace has been triggered by factors such as release of earning reports, political crisis, adjustment of interest rate policies. We just saw the Bank of Canada increase interest rates by 75 basis points about half an hour ago. News of mergers and acquisitions, changes to certain fiscal policies. Those things automatically create volatility in certain areas, and not every stock will react the same way. So to your question is, yes, is it considered volatile? Yeah, we've seen downward slope in the last 6 months, and most of that, some of the variables I just listed, have stemmed from that. Where we're seeing that volatility is coming, where the investors are looking and saying Canada could be potentially coming close to a recession. Things are slowing down. What if the consumer rolls over? Earnings are getting tighter. The big thing that the Bank of Canada is looking at right now is inflation, and inflation numbers are rising. We're looking at a potential another hike in October, right? So those are things that investors have reacting to, and it's a sentiment, and by reacting, it creates that volatility.
Got it. And then if we are in a volatile market, and there's so many things that are going on, there's inflation, there are all of these interest rate changes, there's job reports coming in and out, there's a war out there. It's like lots of things that could probably make the market volatile are all happening at the same time. One of our goals is to democratize not just real estate investing, but also investing knowledge in general. And we've always focused our webinars specifically on investing knowledge. And at least my personal belief is institutional investors, HNIs, family offices often have access to a wealth of knowledge from people like yourself. And so I am sure they are able to make potentially better decisions than people who are just caught up in their jobs, and not that they are any less smart, but they just don't have the time or the specialized knowledge to make informed decisions when you are stuck in a volatile market. Like I have a lot of Amazon stock, which was great when the market was going up. Suddenly it doesn't look like that. It is like half the size it was a few months ago. So should I rebalance it? Should I sell it? Should I just hold on for another 10 years? What if I want to buy another property? What if I want to invest it somewhere else? And those are decisions that right now is just intuition and asking a few friends, for me and for a lot of people. So asking you the question is, what are the biggest mistakes people could make in a volatile environment? And how does this decision making in a volatile environment vary between institutional investors? Like how would they react? How would, say, a family office react, HNIs, and then obviously retail investors like myself? So across the spectrum of investor type, how does this vary?
Yeah, it's a very good question. I'd like to more or less answer that question in two parts.
Okay.
The biggest mistake, and I'll give an example in my history. I started on Bay Street in 1999. This is when technology was at its highest, and then everything, the world more or less collapsed around 2000. When technology blew up, then September 11th came, then all of a sudden mining came back alive. Gold was hot. Gold was below $200 prior to September 11th. We go through these gyrations. So you had technology, anything with the .com in 2000 was doing well, then it all blew up. I tend to look at that when you start seeing mining companies becoming technology companies. And then it goes reversal, where all of a sudden you have technology companies becoming back mining companies. Then you had these mining companies becoming marijuana companies. Then these marijuana companies becoming psychedelic companies. And it goes through, and Canada has these cycles. And the biggest mistake I've seen is, and using your analogy with your Amazon stock, is the first part of it is every individual, every investor has to have a plan. And that's one of the key differentiating factors between a high net worth individual, institutional, or an individual. You have to have a plan and an objective. And, and the reason that's very key, you have to know your time horizon. What am I doing this for? Am I doing it for retirement? Am I doing this for my children's education? Am I doing this for a vacation fund? Or is this an emergency fund? Once you have that plan in place, and that's the key differentiating factor, what's happening right now, in the long term, this is a blip, right? Recessions happen. Recessions always happen. On average, recessions last for about 200 days. And a recession really and truly is defined by 2 periods of negative economic growth. So if you looked at Canada during COVID, when at the onset, we had 2 negative periods. So technically we had a recession, right? But knowing all of this, and you have that plan, you basically match your objectives to the overall plan. The biggest mistakes investors make is by sitting out on the sidelines. Without a proper plan, emotions, and we're human beings, emotions rule you. You turn around and say, well, at the end of the day, maybe Amazon will go down to 0, or maybe Amazon will go down to $25, and I don't know what I'm going to do. And you then basically pull it out and you sit on the sidelines. And when you sit on the sidelines, historically speaking, by sitting on the sidelines, you miss back that uptick. You miss back the uptick, and all of a sudden you miss that big return when the markets rebound. And that's when you do that, because it's an emotional instinct and you sit on the sideline. So our portfolios, we haven't done anything. We haven't changed our portfolio configuration, given that we're long-term investors. We're looking at stocks, and we pick a stock. Fundamentally speaking, the stock performs well. And you will always have blips with volatility. But at the end of the day, our clients understand it's meant for long term. So to getting back and summing everything up, mistakes, don't sit on the sidelines. You could potentially miss out on the returns. But that question must go hand in hand with, you have to have a plan, right? And what I found is the key difference between investors that potentially a lack of time, or they're doing things on their own, is they don't necessarily take that half an hour of actually saying, what exactly are my objectives? And how much risk can I accept? If you're a short-term investor and you've got a 1-year time horizon, I would say stay in cash, because it's going to be volatile. It's going to be a choppy road ahead. But if you're going for 3 to 5 years, looking for retirement longer term, you would stay with stable, fundamentally speaking, assets, things that produce income, things that have growth at a reasonable price. So, that's how I would sum it up, Krishna.
Got it. Thank you. Thank you, Ron. It made me think that I'm not sure I have my plans laid out either. It almost was like a moment of reckoning to say, okay, I'm hosting this webinar, but maybe I need to go back and revisit my plans as well. And so you mentioned that in your portfolio, most of your clients are just simply staying put. So they are clearly not panicking like I am to say, should I sell? Has Amazon peaked? And to your point, I've already done that mistake once where I sold a whole bunch of Amazon stock, which I regret every day of my life afterwards, when it was at 1,000. And I didn't need that money. I just thought, I don't know if it's going to go up any higher. Random, no rationale, gut feel, emotional reaction to market trending lower slightly. And then 3 months later, it was at 3,000. So whatever I sold would have been 3x, except I just narrated that story now to everyone and regret it. And so those things happen. But when you are staying put in a volatile environment and in changing environment, if your time horizon is, say, 10 years, you would still need to rebalance the portfolio, or so it seems. So how do you go about doing that? And would you, like when you are recommending clients, is it mostly stocks and bonds, or would it also include things like real estate? Like how do you ensure that your overall investment basket isn't going down over time? Because it is possible that Amazon and Google are attractive today and they are not 10 years from now, because companies also go through cycles. So how do you rebalance between the different kinds of asset classes, as well as within an asset class? Or should you rebalance at all, and how frequently should you rebalance?
Well, in essence, given, let's say, year to date, and year to date, it would trigger certain rebalancing in portfolios. And that's primarily with our investment management committee. When we get together, we're looking at certain sectors. And, obviously every name that we've picked in a portfolio are names that we believe that will perform well in any environment. And these are companies that are well run. But like you rightly pointed out, some companies, some environments, some sectors change forever, right? For example, if you were the person investing in, Britannica encyclopedias, nobody buys an encyclopedia anymore. Everything's online. That business is dead. Or people that did Pearly maps when you were back in the old days looking through the map, GPS has eliminated that entire business. So essentially what we do, first and foremost, is it doesn't trigger a rebalance right away. The only time we would trigger a rebalance is we already have targets within certain sectors. Right now we're overloaded on financials, where we have our higher weighting is in financials. We have minimal oil and gas. That's primarily because we think it's already at a high. So we do look at valuations as a key thing when guiding how we rebalance. So first thing is we're not going to trigger a rebalance right off the bat. Second is if we see a gain in some of our positions, we would trim that gain and move into something that has come down or dropped dramatically. So to your point, volatility is not necessarily a negative thing, given that you do see some nice names that have now become cheaper, right? So using your Amazon example, all of a sudden Amazon's fallen dramatically, it's become cheaper. It may be an opportunity now looking at Amazon and saying, should I buy it, right? And what's the story? So our overall, we approach it on a macro view of how a company would perform and that sector and how it would perform before we make a move. Our velocity of trading is not, we're not day traders. We probably trade, maybe once a month, if that, given that the names we feel very comfortable that we pick will perform. Now, I'm no different from a lot of other portfolio managers, given that in order for a name to be included in our portfolio, we've gone through over 6 months to a year of due diligence before we even add it. Given that we have something that it's not necessarily we've refined it, it's called an all times period analysis, where we actually look at a stock historically throughout all the periods. And this is not 1 year, 3 year, 5 year, it's month over month to deliver our clients at least minimum a 5% rate of return over a 3 year period. Now that's mirrored to, let's say, what a GIC would give you. So that shows every negative downturn of stock. It sees it. See the thing in Canada, when you look at performance numbers, everybody looks at a 1 year, 3 year, 5 year, but they never look at the end date. So our performance numbers are biased by end date bias, because you can look at the performance now, open up your returns and look at the return and say, I did 10%. I might hold the exact same product and I did only 5%. The thing is, you bought it in January, I bought mine in March. And hence we missed that couple of months of performance, right? Now, certain sectors, getting to your question, certain sectors we stay away from, because how we manage money is that we stay away from the technology and the resource sector. And that's by choice, not because they're bad sectors, it's because they add a lot more volatility. And our overall mandate is sleep at easy money. I don't want clients to be worried and looking at the news report all the time and saying, oh my God, markets are falling apart. Mr. Putin is just, attacked another country beyond Ukraine and the whole world's falling apart. This is money that you work very hard for your money. And as such, just recognize this is our plan. We're going to deliver, anywhere from 8 to 10%. And we're not going to get into those sectors, given it'll create undue stress. Now, what we've seen when it comes to things like real estate is that it's an alternative. And you've seen a lot of, everyone's looking for yield. And with an aging demographic in Canada, older folks tend to look for income. And, a lot of individuals are looking for income, especially in your retirement years. You need that income to supplement the loss of, being retired and then that income you would have gotten from your job. So alternatives do provide that income. So things like mixed mortgage investment corporations, even your product, given that people want to invest in hard assets, they could see it, they could touch it, they could feel it. And it really goes back to traditional investing. So real estate's actually performed quite well. Not all real estate is created equally, as you would know. The rental market provides some great opportunity. We're seeing a few REITs that are involved in apartments that have done quite well. In fact, we've just recently added an apartment REIT to our shelf of products that we can offer. So those do give us potential, but it's not added to all portfolios. Getting back to basics, it's all based on the client's objectives. If they're looking for income, these products provide that income. If they're looking for growth, obviously will be a little bit more growth bias. So in essence, we do not rebalance just because we're seeing this volatility right off the bat. We will only rebalance once a portfolio goes out and starts to drift away from our model portfolios.
Got it. So these days, and I think maybe I am attuned to that generation that's used to robo-advisors and auto rebalancing is the biggest push, or that's the biggest sell. Actually, to be honest with you, it sounds really attractive that something is going to constantly rebalance my portfolio to be better every day. You are suggesting not to look at it every day. Is that what I'm concluding?
Yes.
How often do I revisit then if I were doing this on my own?
I would revisit and look at your portfolio at least on a monthly basis, not every day. Look at it on a monthly basis. Most brokerage firms provide you a statement every month. And most clients, see, that's where an advisor comes hand in hand, is to hold your hand to say, Khushbu, your $10,000 that you invested in January is now worth $8,000. But you understand, you're educated, this is what has happened. But this is going through a cycle, right? We would already, when we speak to a client, we already know how they look at risk. Clients have an aversion of losing money. So, and that's a human trait. So I've just lost $2,000. If I've lost $2,000 to a person that's looking to exit next year, yeah, that's going to scare them, right? But a person that's looking to say, well, I'm in here for 3 to 5 years, I understand, and you've been educated. And that's something a lot of advisors don't necessarily do. They don't educate their clients to know exactly what to expect. Most clients are aware of what's going on and they get it because they're seeing portfolios. They may have portfolios elsewhere and they're seeing them fall, and they'll come back and say, hey, Ron, yours didn't fall as much, right? And I get why you're doing it this way. Now, getting back to your point about robo-advisors, you see, investments, everybody's taught about modern portfolio theory. You can diversify away this entire, systematic risk. So systematic risk is in the system, unsystematic risk I can diversify. So we're taught to diversify. And diversification is a great thing. But when you look at Canada as a whole, financials and resources are over half of the market, right? So essentially you could turn around and say, I own Canadian Natural, Suncor, Royal Bank, Manulife, and I already have the TSX. That is the TSX, right? Because the entire market capitalization of those big institutions and those sectors is more than half of the entire market. That's why when you're looking at Canada, I don't necessarily believe in diversification. We run a very concentrated portfolio. Given that when you diversify, these robo-advisors diversify, thinking they're doing something better, there's something that they miss is correlation. Correlation, all it simply means is that when one asset goes up, and if both goes up at the same time, they're positively correlated. But if one goes up and one goes down, then they're negatively correlated. Ideally, in a perfect world, what modern portfolio theory is trying to capture is when one's going up, one's going down, you get the middle. But we're working in Canada and the entire North America. We're all correlated. So what happens in the US will happen in Canada. What happens to the Canadian banks? Well, what happens to the US banks will happen to the Canadian banks. So when we're picking stocks, you might as well pick something that's great, knowing they're all going to do the same thing. Getting back to how we started off with volatility, well, if all of a sudden Microsoft comes up with numbers tomorrow and say, oh, we see demand falling, and things don't look very rosy to the end of the year, that signals to every technology company things are not going to be rosy. All of them will fall, good or bad, right? Because they're all correlated and the sentiments are driving it. Oh my God, a big company like Microsoft came out with bad news, so it must be bad, right? So, at the end of the day, I'm not a firm believer of diversification. I believe diversification is basically fixed incomes and equities, but all of the equities essentially do the exact same thing. They're all going to go up at the same time, and they're all going to go down at the same time.
Yeah, and for us as Buy Properly, we are often asked, how are you different from REITs? And that's one of the things. Like, people believe in general, and you probably watch a lot of REITs very closely, is that REITs are a good diversification away from stocks. But if you're talking about publicly listed REITs, and we've done a lot of correlation analysis, they just move in tandem. So when you're choosing a REIT, you're just choosing another company that moves up and down along with the rest of the stock market. So if the indices are going up, the REITs will go up. And the correlation when we ran our numbers was as high as 0.7 to 0.9, which means they were basically the same as picking another stock. So I could just invest in an index fund, and I would have the same outcome as I would with a publicly traded REIT. And that's kind of our stance to say, okay, if you want to diversify away from the stock market, then you have to do something very different if that's your goal. Because unlike you, I'm on the contra side. I believe in diversification, theoretically, although I don't know how much I can apply it in practice. But at least with the private deals that we are doing, we ensure that fundamentals are strong. They are actually value deals. So independent of how the market does, they will do fine, which is why maybe we are very slow in adding deals. But it's like, sometimes my team is like, oh, the markets are going down, the prices are going up. And it's like, yes, but if you look at a 5-year horizon, will it still be making money, and will it be in the money? If the answer is yes, then we are okay. If this is something that we were just riding a greater fool's theory and buying expensive, hoping somebody will pay even more, then we may be in a problem.
Oh no, and Kushbu, I mean, and I'll just clarify further the diversification comment I made. It's among stocks.
Okay.
Why Buy Properly is unique is that, and you hit the nail on the head, given that with REITs and investors, I've seen start chasing yield, and they start saying, well, this one's paying me 10%, this one's paying me 8%. I'm going to go for the one with 10. But they have to understand how yield is calculated. It's basically the dividend over the price of the stock. So the yield starts rising if the stock is falling. That's the first thing, and they don't get that sometimes because your principal is falling and you're just getting a higher payout. That's the first thing. The next thing that's made it very cumbersome with REITs in comparison to Buy Properly, which is very simple, and it addresses two things. It addresses where we're seeing the demand come from, and obviously you're in the hard asset business, is that with REITs now, not all REITs are created equally. Some REITs are, if you own strip plazas, well, you might have a problem. Yeah. If you own malls, well, they're redefining themselves by now all of a sudden attaching a couple of condos to the malls, right? Or if you just own warehouses, oh my God, Amazon and everybody else loves your business because they like the warehouses. Warehouses are great. So the question is, now you have to diversify within your REITs. Which REITs do you want, right? Which REITs do you want to, explore? With your model, what makes it different is that I believe the rental markets, with rent controls being eliminated, is the place to be. Equifax released numbers this morning that showed consumer debt levels at about 2.3 trillion. 2.3 trillion, right? And year over year, that's the increase. CMHC announces that over 52% of Canadians have variable mortgages. If this continues, and like I said, the volatility will be there. We're not out of the woods, but that should be matched to your time horizon. With your product, at least it adds consistency to the portfolio, given that the average consumer may not be able to purchase homes, and they will be renters. And TD Economics came out saying they anticipate housing prices within certain areas to fall by at least 20-25% by next year. And we've already seen areas to fall by 10-15% already. So it's a good opportunity of acquiring things at lower prices and knowing the demand is there for renters. So it does offer a lot of consistency. And tying this all up, it's based on what the client's looking for. If they're looking for income and they want something and believe in that thesis that the prices will appreciate, real estate markets are not going to fall off, given that if you look at Ontario, just under 50%, the Toronto GTA is the population of the entire Ontario. So the population, the nerve of Canada is within the GTA. So right off that bat, that population is going to grow, whether it's immigration or people coming in seeking employment. And the first thing they need is housing. And if housing prices fall off, you might see guys go in to buy homes, but you will always have renters. So it's a great opportunity, and I think it's a nice marketplace. It's not without risk. And obviously the risk is, and everybody, that's the biggest fear, is that the consumer will roll over, and the consumer will roll over given that they have a higher levels of debt. But we haven't seen that yet. You know, it's marginally, we've seen a rise in proposals of people, you know, re-engineering their credit, but we haven't seen, you know, it's marginally increasing with bankruptcy. The consumer is relatively strong. So, you know, at this point in time, it's not, I don't subscribe to the doom and gloom. I do believe that we will have some volatile periods ahead of us, but it does, you know, provide a lot of opportunity for the very patient investor.
Got it. Thank you, Ron. Let me check what the audience is thinking about some of these times. So want to get a sense of how has the current market volatility impacted your investing practices, and see what they are doing. I see a lot of I see votes coming in for tracking and timing the market way more closely. The last time we were doing a similar poll, most people had suggested that they are trying to time the market and they are looking to buy the dip if one happens.
Yeah, I mean, these are market timers, right? We have not changed our overall philosophy. Our philosophy still stays the same. Timing it is like flipping a coin. I might get it right, I might get it wrong. And you know, you go back to that old traditional thesis, do I have a portfolio manager like myself, or do I buy an ETF? Right? You know, are you passive or aggressive? And you know, one will win. It depends on what time frame you're looking at. So we're not market timers. We won't time the market. We are all about staying put and following your goals and your time horizons, but being aware of what risk levels the clients can take. And not every client can see depreciation in their portfolio and like it, right? And in many cases, those are clients that traditionally will have to be more fixed income oriented, clients that don't want to see the dip or staying larger cap names.
Yeah, I am personally also not a big believer of timing the market. I think one of the things that you can do in the stock market, which is what we are hoping that Buy Properly can do for real estate, is dollar cost averaging. So you continue to buy and invest small amounts on a regular basis rather than try and time the market, and your average returns will be higher. So if you're investing in the stock market, even if you're investing, say, 2,000 or 3,000 or 5,000, but on a very consistent basis, chances are you will have over time made some gains and made some losses, but net you will be better off than trying to get it absolutely perfectly right, which means you are essentially taking a bet, like you're saying, like a flipping a coin on whether or not you would be right. And unfortunately, you can't do that with real estate when you have $1 million properties. I mean, I know somebody who recently bought a $3 million house, and I was like, the only other person I know who's bought a $3 million house is Maria Sharapova, who bought a house in LA for $3 million. It's like, I don't know, and they are like just regular people. So I don't know how much of a stretch the mortgage is going to be on them. I think the better way of probably real estate investing would be to be able to do something similar to stock market, is when you're constantly investing regular amounts in the real estate, and hopefully with small fractions. That's something you can do. So if you're investing 2,500, you can do that more often than when you have to put down 200,000, which you cannot be doing on a monthly or a quarterly basis as a regular person.
Yeah, no, it's a brilliant strategy. You commoditized, you know, a unique asset class and basically made this into an investment vehicle. And the average cost base is important, and a lot of clients never really looked at, but it's a strategy a lot of investors have. You know, they call them, the banks call them packs on a monthly basis, where, you know, they take a couple $100 out of their paycheck and it goes directly to a mutual fund or some sort of portfolio. And to your point, really that comes to their advantage, because as this product is fallen in price, you acquire more units. So your overall average cost base falls. So when you do sell, the loss may actually not be a loss, or you mitigate some of that loss, or you may be in a position of a gain. So it's a brilliant strategy. But I like you've put it very nicely. It's something that I believe a lot of your clientele probably already do, but it's a good suggestion of moving in. And the beautiful thing is, Khushbu, and like again, another good point is you can actually invest in a myriad of different properties, different areas, different segments, and have a very diversified portfolio within real estate.
Yeah, absolutely. A lot of our clients actually do this. We've noticed there are people who've done 6 or 7 investments. So they basically keep investing about the same dollar amount, but every month they will invest in a deal. And so in the beginning, we were excited about it. We're also scared. It's like, what are they doing? But over time, we've learned that, okay, they are trying to do the same thing that we talk about in stock market is dollar cost averaging. Is like, they cannot get it right. We cannot get it right. If people could get it right, yes, it will be chasing money, and like money will be chasing to invest in that asset, and it will become expensive. And the returns will, market economics wise, go away. And so the only way to do it is when you're constantly investing in various kinds of asset. But talking about various kinds of asset, you talked about stocks, you talked about fixed income. One of the questions I often get is, given that there's a forecast that housing prices will fall, given that there's all of the market interest rate craziness, so mortgage is expensive, what do you think of real estate versus investing in stocks or any other at the moment? And should real estate investors be scared? If you ask me, the stock market and the crypto market are in shambles. So comparatively, real estate is not even that volatile. It's like way better scenario in real estate than the rest of the investment options. But I want to know what you think about whether real estate is a safe investment, especially in the current context of rising interest rates and volatility.
I mean, real estate is not a bad investment in the current environment. We've seen a lot of folks that have consistently done well in real estate, and they've built that overall base. We actually have clientele that only invest in real estate, and their stock portfolio is a very small component of their overall net worth. Now, I believe you can do both, given that real estate does have its gyrations, and a lot of it is a function of interest rates, like you rightly pointed out. As interest rates rise, you'll find it much more difficult to buy property, and you should more than likely see prices of houses fall. As an example, I remember my parents' first mortgage was at 14% back in the 80s, and that was considered normal. If Canada still goes at the inflationary band of, 2% inflation, we're going to see interest rates rise more, given core inflation is still relatively high. So to answer your question, I believe real estate in the current environment is a safe bet, but I put that side note on it. You need a proper team and this is where the buy properly team comes in, to obviously assess, where is this real estate? What are you buying? Why are you buying it? All of the necessary boxes need to be checked off, given that not every asset is going to be the same. So for example, folks that, we were actually managers for a MIC, the MIC has actually rediverted money to the point that we're not leading to condos. None of the condos developments in downtown Toronto. And then somebody might say, why? Well, because COVID created this huge vacuum where investors then realized that, I'm going to go buy a closet for $1 million, 400 square feet downtown Toronto for $1 million. I can work from home now, and for that same amount of money, I can have a 3,000 square foot house up in Niagara Falls. And I could probably save a lot more, I don't have to commute, no more car. So if you see that shift and somebody can pick those things off, and obviously I've seen some of your projects, you do have some things going out of the GTA, it definitely caters to where we're seeing those shifts happening. We're seeing a lot of development moving out, like for Hamilton area, St. Catharines, we're seeing that move out where the prices are better and individuals are refocusing. One thing millennials in general, and it's very common in the US, they're renters. Millennials are renters. And, it's a society where everything is done by technology and they want to be very simple. So it caters to that group of people as well, given that they want to sit at home and do everything online, right? So I do see real estate as an asset class. I would never say be on 100% real estate. I always say, when I said diversification, I'm against diversification. That's only within certain stocks, but it's also is to look at your entire overall net worth and having both baskets together.
Yeah, I mean, the trend is definitely moving out of GTA. We've been very bullish of areas outside of core downtown. And you're right, the younger generation is doing the exact math that you are doing. I mean, my younger brother, I live in Toronto. I don't live in the suburbs. He used to live in Toronto. And from North York down to the beaches area, he thought it was a long commute. He only wanted to be 2 subway stations from where his office is. That was his criteria. So he was only renting because 2 subway stations from downtown is not cheap. And then come COVID, he decided he wants a large backyard. So he moved to Hamilton, and I think he literally just bought a backyard. There's less house, more backyard in his house. So he has some house, but mostly a huge backyard. But he was more than happy moving to Hamilton because now he only needs to go to office maybe once a week or max twice a week, versus a huge shift from when he was planning to be a renter for all foreseeable future, living only max of 2 subway stations away from his office ever. So there's definitely a shift towards that. And we've seen our Hamilton properties do well, both on rental and prices. Of course, it's quite expensive by now. But talking about safe investments, I am hoping the answer to this question is yes, but I do want to run a poll and see what our investors think, especially given the current volatile environment. We do get a lot of questions. A lot of people get kind of jittery when they see the interest rates go up. The truth is, if you have like value assets, they'll be okay over a 5-year period. They may not be okay if you want the money out now. To your point, it all depends on the time horizon.
Yeah, you're absolutely right. I mean, in the current environment, we started off this conversation with volatility. We always move from value oriented to growth, and then growth back to value. And investors really, when they start seeing volatility, everybody starts thinking, show me the money. Can I, is the company making money? I like it. Can I feel that asset? And that's why they move back to these asset classes. And then 3 years from now, when everybody turns around and says, oh my God, Chris, you're only making 8? I just made 30% on this technology play. What are you doing? They go all the way back to growth. And it always goes back and forth between value and growth. It's clockwork. So in the current environment, yes, you're absolutely right. Value plays where we traditionally go back to bricks and mortars, and our names have always been defensive. We're biased towards, and when somebody says, what type of names do you own, Ron? It's always been defensive names. People need to eat. They have to pay for the utilities. So like an Enbridge, a TD, a Metro, a Loblaws, those are names that we have in our portfolios. Given that it's steady Eddie, and it's not that discretionary spending component where you need it, it has relatively inelastic demand, and it's consistent. So the thesis with real estate is that it's value. I can see it, I can touch it, I can go to that address if I wanted to. And the model is very simple. You buy something, I've done my homework, it's got good chances of appreciation, I can rent it. Simple. I don't need to hear on, looking at, let's say, another play, oh, I'm 1,000 times, I'm trading at 1,000 times, I have no revenues, and I could potentially be this. And that's the word, potentially be this, right? So, it's definitely falls right into that value play.
Got it. Cool. Looks like 50% of the people were actually unsure of what to make of the current environment and in the context of real estate, but 50% are like, they think it is safe. So it's quite a split, I would say.
Well, I mean, if I may add, I was looking and reading some research reports on the US. If you look at the US side, and here's a weird thing. I mean, you and I are out of this age category, given we're slightly older, but if you look at the age group below us into the 30s, and it's very common in the US. If you look at the Sun Belt regions in the US, if you look at the Phoenixes, the Tampa Bays, very hot areas, the Dallases and so forth, they are renters. Kushbu, you're frozen. Hello? In the US Sun Belt region, we found that, if you look at, it's an income thing. If you look at strictly, if it's your first time home buyer, and let's just say you and your spouse make $150,000 on an annual salary, and you have no down payment, theoretically, you can't buy a house. Given that the average home price is about 800, 900,000, depending on where you live. So you can't buy. So the other option is renting. So it does address a huge component of the market. I mean, the government is desperately trying to, come up with programs that would make housing affordable. But in general, the people that are moving the houses is because they've owned a house 10 years ago. And, they bought it for 400,000, they sold it for $1 million and change, and they can move into something larger. But for the first time home buyer, I believe the home buyer's plan now is, $35,000. What's that really going to do? That's going to pay legal costs and land transfer tax. That's not going to help you necessarily with a down payment. It does help you, but nothing of substance. So, we're definitely in a renter's market.
Yeah, we've added a few properties in the Sun Belt in the US as well. We've added 2 in Arizona and 1 in Texas. We are hoping we can add a little more in the Sun Belt. And even in Canada, to your point earlier of having a good combination of the type of asset classes, we are hoping we can bring more properties that are more fixed income kind. So properties in Windsor or Timmins or Sault Ste. Marie, which will probably not see crazy appreciation like GTA does. So like Hamilton properties that were probably for 200 are for now 600. In like maybe 3 years of just us being around, we've seen it go from 250 to 600 right now. It's like, no way the same house is selling for 600. But these houses will probably not go through that kind of crazy appreciation. The good thing, however, is there are a lot of renting towns. Like Timmins is a renter's town because it has a mining resource and people aren't there necessarily to stay there for the rest of their lives. So they are renting. And the houses are worth 200 to 50K, but they still generate substantial amounts of rent and very low costs overall. And so it becomes a more fixed income rental play. So it's like, it will generate $1,000, but it will continue to generate $1,000 for the next 20 years. And so you will recover your money that way. And yeah, the principal doesn't appreciate, but you get cash on cash returns. It's adding that kind of property in the portfolio.
Yeah, and I've seen that. That's a very good strategy. I've seen that in Kincardine, Ontario, where a lot of the folks there are renters because they all work at Bruce Power, and cycle the workers. They basically go home on the weekends, but they need a place to basically sleep and eat, 6 days a week. And these guys team up, and the rents for a house are like $4,000 or $5,000 a month. Because the company like Bruce Power, not for all workers, but for some workers, give them a stipend to basically pay for food and housing. So it works out. So the landlords can charge because they know Kushbu's got 1,000, Ron's got 1,000, and somebody else has got 1,000, and like, okay, well, let's all put our money together and we can rent a place. So let's rent a house. So there are many little cities in Canada that have an industry. Obviously, certain industries have fallen apart and those cities have died, but there are certain cities that those industries will definitely continue to grow. Timmins, Sudbury, those are areas that are poised for growth. But I've seen the bad cases. Look at Fort McMurray. When oil prices fell, the city more or less fell apart because the oil sands have a very high cost to extract. $40, $50 a barrel. And if oil's at $40, $50 a barrel, it doesn't make sense to do the oil sands, right?
Right.
So, but that fell apart, but in its heyday, it did quite well.
Fabulous. This was an absolutely good discussion and thank you for all of this.